It wasn't a trade dispute. It wasn't a diplomatic signal. It wasn't even a standard portfolio rebalancing. It was the structural rejection of a failing liability. The pattern is unmistakable. History shows us exactly what happens when a rising power realizes the dominant reserve currency is mathematically insolvent. They do not announce their exit. They do not hold press conferences to declare war on the incumbent currency. They simply exchange paper promises for physical reality. They trade debt for atoms. This is not a new strategy. It is a defensive mechanism that has played out across centuries of imperial transitions. The arithmetic is merciless. When the issuer of the reserve currency debases the unit to fund its own survival, the rational creditor has only one move left. Get out early, and get out into assets that cannot be printed. To understand why Beijing is stacking silver and dumping treasuries, we must look at the precedent. We have 3 specific historical files that explain this behavior. In each case, the timeline follows a rigid sequence: peak dominance, unsustainable costs, a monetary shortcut, and finally, a desperate flight into hard assets by those who saw the end coming. Consider the Spanish Empire under King Philip II in the late 16th century. Spain was the master of the world. Its dominance was absolute, but the costs of maintaining a global empire were suffocating. Wars in the Netherlands, conflict with England, defense of the Mediterranean. The Treasury could not keep up with the burn rate. The chosen monetary shortcut was reliance on the massive inflows of silver from the Americas. They treated it as endless revenue rather than a finite resource. Simultaneously, they debased the copper coinage back home to pay domestic bills. The result was the price revolution. Inflation tore through the Castilian economy. Prices for basic grains doubled and then tripled. The currency lost its signaling power. The flight to hard assets began quietly. Merchants and nobility stopped holding the king's coin and began hoarding land, wool, and unminted bullion. A shoemaker in Toledo found that his accumulated savings in copper vellon could no longer buy a week's worth of leather. The middle class was hollowed out. Spain defaulted on its debts in 1557, 1575, and 1596. The empire remained, but its financial heart had stopped beating. Just like the Spanish Empire, the British Empire faced its own reckoning 3 centuries later. By 1914, London was the financial capital of the world. The sterling was as good as gold. But two world wars shattered the balance sheet. The imperial costs became mathematically impossible to sustain. The chosen monetary shortcut was the suspension of the gold standard and the accumulation of massive war debts. By the 1960s, the outcome was inevitable. Inflation began to tick upward. The stability of the pound was a fiction maintained by capital controls. Smart capital saw the writing on the wall. They began a quiet flight into hard assets. They moved into Swiss francs. They moved into gold. They moved into real estate. In November 1967, the dam broke. The Prime Minister announced a devaluation of the pound. A clerk in London, who had diligently saved in government bonds for his retirement, woke up to find his life's work devalued overnight. His paper savings remained, but his purchasing power had evaporated. The British middle class faced a decade of stagnation, while those who held physical assets preserved their wealth. Just like the British Empire, the Weimar Republic offers the most extreme example of this dynamic. By 1923, the German structure had disintegrated under the weight of war reparations and the occupation of the raw industrial zone. The government's chosen shortcut was naked money printing to pay striking workers and foreign debts. The resulting instability was total, and the flight to hard assets became a frenzy. People didn't just buy gold or silver, they bought anything tangible: pianos, machinery, scrap metal. A factory worker in Berlin would rush to the gates at midday to throw his pay packet to his wife, who would run to the nearest shop to buy bread or coal before the price rose again by evening. Those who held paper assets were wiped out completely, while those who held physical goods or precious metals survived the reset. The middle class was not just priced out, it was erased. The pattern repeats in 7 distinct stages. Stage 1 is the accumulation of debt to finance. imperial overreach or social entitlements. Stage 2 is the realization that the debt cannot be paid back in real terms, only in nominal currency. Stage 3 is the weaponization of the financial system to force creditors to hold the debt. Stage 4 is the subtle debasement of the currency to lower the real value of those liabilities. Stage 5 is the awakening of the major creditors who quietly begin to exit the paper market. Stage 6 is the visible flight to safety, where the public realizes the currency is losing value and rushes into commodities, land, and precious metals. Stage 7 is the final fracture where the paper system resets, and wealth is measured only by what you physically control. Just like the Weimar Republic, we are seeing the warning signs of the later stages in the modern global economy. The United States enjoys the exorbitant privilege of the world reserve currency, but the incentives have shifted. The sheer volume of federal debt has rendered traditional repayment mathematically impossible, as interest payments alone now rival the defense budget. Under these constraints, the rational move for a major creditor like China is not to hold the debt until maturity. The incentive is to swap that paper for something that carries no counterparty risk. Silver is not just a monetary metal. It is a strategic industrial asset essential for the energy transition. By selling treasuries and buying silver, Beijing is effectively trading a depreciating political promise for a critical material resource. Current data suggests that central banks globally are buying gold and silver at the fastest pace in decades, positioning themselves for a world where the dollar is one of many currencies, not the sole anchor. Some economic historians note that the dollar has survived predictions of its demise for 50 years. They argue that the network effects of the US financial system are too strong to break, and that there is no viable alternative to the Treasury market for storing deep liquidity. This view relies on the assumption that the future will look exactly like the past, but the arithmetic suggests otherwise. When the supply of debt outpaces the global demand for that debt, the price must adjust. The risk is that the adjustment happens not through a slow decline, but through a sudden repricing of real assets against paper liabilities. History shows that when the hegemon weaponizes its currency, as seen in recent sanctions regimes, the incentive for rival powers to exit that system becomes existential. They are not trying to destroy the dollar. They are simply trying to ensure they are not holding the bag when the music stops. We can look to history to see the three potential endgames. The first is controlled decline. This mirrors the British experience after World War II, where the empire recedes, the currency loses dominance, and the standard of living stagnates. But the system holds together through capital controls and alliances. The second is chaotic collapse. This mirrors the French assignat crisis of the 18th century or the Soviet collapse of the 1990s, where confidence evaporates overnight, supply chains break, and the economy undergoes a brutal shock therapy where paper wealth is obliterated. The third is reset and restructure. This mirrors the Bretton Woods Agreement of 1944, where the major powers convene to establish a new monetary order, likely pegging currencies to a basket of commodities or a new neutral reserve asset to restore trust. In all three scenarios, the holder of paper debt is the loser, the holder of physical assets is the survivor. The move into silver is a hedge against the chaotic collapse and a positioning for the restructure. It is a vote of no confidence in the current ledger. The only variable is timing and pain. If you want to understand the mechanics of this transition and how to build resilience in your own life, subscribe to the channel. We analyze the data without the noise. Educate yourself on monetary history. Build skills that have utility independent of the financial sector. Pay attention to the flow of physical goods, not just the movement of stock tickers. The era of easy paper is ending. Prepare accordingly.